Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, April 27, 2010. We start with the euro-dollar pair, in which we saw the euro plummeting against the dollar and the yen as well today, as we had fears that a sovereign debt crisis could spread from Greece to other countries within the eurozone, which led investors to flee riskier assets. Overnight, we had some political back and forth between Eurozone officials, with the latest being another shot across the bow from Germany's Angela Merkel that a Greece bailout wasn't a done deal, which soured risk sentiment overnight and drove investors to safe haven currencies such as the dollar and the greenback. We had sovereign credit default swaps continue to increase for both Greece and Portugal, with the 5-year CDS swap rates rising to a record high in both instances. There was also some talk about raising the subject of forcing investors to take a discount on Greek debt in the talks with the IMF and the ECB. In essence, banks that were holding Greek government debt should be made to help to contribute to a rescue of Greece because they had profited from the crisis in recent months and also had speculated against Greece. That would mean that whoever bought Greek bonds wouldn't get 100% of their value, but say only 80, 90, or 70%. Needless to say, that would throw another curveball into the negotiations on the 8 package, but such restructuring of debt is still not a foregone conclusion within the 8 package. When we moved into the New York session, we had a further increase of risk aversion as we had the rating agencies Standard & Poor's downgrade Portugal's long-term government debt by 2 notches to A- with a negative outlook, while citing the fiscal and economic weakness as well as the lackluster growth potential in the country. The euro dropped on the news, but didn't fall to an intraday low, hovering around 1.33 here, until we had the S&P then issue a downgrade of Greece's long and short-term debt to BB plus and B respectively from BBB plus and A-2. The downgrade pretty much to junk status triggered a steep drop in the euro as it increased again the uncertainty and risk aversion within the markets. By the end of the day, we were testing the 1.32 area, which was our low in Friday's session. Taking a little bit of a longer term view of this pair, we see that we had moved below our support at 1.33 in last Friday's trading, but we had moved above that level and had used it as support in yesterday's session. But today again we break below that support, and if we move below 1.32, then we could see further potential downside for this pair. So overall, it was a very poor day for the euro, and with we still have most of the week to go, so we have to see how investor sentiment develops as we continue during the week. We had similar reactions in many of our other key pairs, with the US dollar and yen gaining at the expense of higher yielders. Here we're looking at the pound dollar pair, and we see that in today's trading. We had been trading at the 1.5480 when we opened today's session, but by the 3 p.m. Eastern at least, we had dropped more than 220 points to set a low at 1.5250. We had mentioned in yesterday's video how the pound the house sterling had come up against a pretty important resistance here at the 1.55 level, and we see that in the atmosphere of risk aversion, we've had a very strong sell-off. We did pause here prior in early New York morning trading around 1.5350, but with the downgrades to Portugal and Greece, we extended this decline to test 1.5250. Here we're looking at the euro-yen pair, and again a very strong reaction in today's trading as we've slid from high to low about 320 pips in the pair, wiping away the gains we had seen earlier in the week. That put us below the lows that had supported us around the 123 level here over the last month. And now we further correct this rally that had started on March 23rd. So the next levels of resistance, if we use Fibonacci retracement levels, we've moved below the 61.8%, and now we approach the 78.6% level, with 121 being our low if this pair continues to fall. The pound yen, which had peaked above its resistance for the month at around the 145 level and reaching a high at 146 yesterday, gave up all the gains it had seen throughout most of last week, testing the 141.50 level. Oil prices took a heavy brunt of the risk aversion today, sliding 2.4% by 3 p.m. Eastern to $82.17 a barrel, and that heavily impacted the US dollar Canadian dollar pair, which had been trending slightly higher yesterday, but in today's session jumped from around around the parity level to test the 1.0180 level as its high for today. So that harkened back to what we had seen in our highs in last week's, when we entered last week's trading. And a look at a second commodity currency. Here we're looking at the Aussie against the US dollar, and we see here too that the commodity currency, the risk, the higher yielder, the currency sensitive to risk appetite, faltered in today's trading as we moved from a high of 0.9280 down to a low of 0.9150. That tested our support from April 18th as well as back here at the end of March, and so far that level has held as support. We had seen yesterday how we ran up against this downward sloping line of resistance as we had several lower highs in a row, which gave us a bit of a bearish inclination to this pair. But now that we've moved all the way down to this support, we have to just see how risk sentiment develops going forward. Today's risk aversion overshadowed some releases from the US that I still want to get to, as it could be important for tomorrow's FOMC statement. First, let's take a look at the S&P Case-Shiller 20 City House Price Index for the month of February, in which we saw annual prices rise to 0.6% from negative 0.7%, with the 10 City Index up 1.4%. That was the first time in more than 3 years that we've had annual prices positive, although we did have a fifth straight month-on-month drop in prices. A second report showed the Conference Board Consumer Confidence Index for the month of April jumped from 52.5 in March to 57.9 in April, which was much higher than the small increase in the index that was expected. It's the highest reading in the index in September of 2008, which was 1 month before the collapse of Lehman Brothers. The Present Situation Index rose to 28.6 from 25.2, while the Expectation Index saw a strong rise to 77.4 versus March's 70.4. Statistics on the current situation in the labor market improved, as did future expectations for the labor market. Continuing job growth will be key in sustaining this positive momentum, as well as to show how willing consumers are to spend. A final report that was released today was the Richmond Fed Manufacturing Index for the month of April, and we saw a very strong rise in activity as the overall index rose to 30 from March's reading of 6. We can see that at least in this sector, we had seen a bit of a V-shaped recovery following our decline during the recession, but then we did see activity ease again in late 2009 and early 2010, but again now we see a continuation of the recovery in manufacturing, which has been at the forefront of the overall US recovery. So this is positive data for the manufacturing sector. So while markets were concerned over the Greece and Portugal troubles, and that moves the investor sentiment in equity markets in today's trading, the positive fundamental data, though the housing prices were sort of mixed, should help increase confidence for the FOMC if they were planning to paint a bit of a rosier picture about the US recovery in tomorrow's statement. With our fundamental and market highlights out of the way, let's take a look at what we can expect from tomorrow's fundamental docket. Tonight in Japan, we get data on retail sales, which is followed by Australia's Consumer Price Index, as well as New Zealand business confidence. Overnight, Germany posts its Consumer Price Index. Tomorrow, as I've already mentioned, at 2:15 p.m. Eastern, we will get the FOMC interest rate decision and statement, which will be followed by 5 p.m. by the Reserve Bank of New Zealand's interest rate decision and statement. So following today's event risk, the FOMC will be our main point of focus in tomorrow's trading. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site fxtimes.com. I want to thank you for watching and wish you good trading.